if you've got a real rock star, I can think of two of my best portfolio companies. In the one case, they've been around for a cycle, and they've had to pivot a couple times. 4 years ago, they had about 15 programmers that they were, happy that they were kind of getting a deal on them because they were all from Ukraine. Now they have zero programmers. They have the CTO, and he's doing everything using Claude and other AI programs and vibe coding. And vibe coding, Claude, etc. It's a whole new world. The winners this cycle, I think, are going to be the ones who are very efficient and are able to go and have a single tech coder that just basically uses AI and doesn't really need a lot of resources because their programming staff is their AI.
Hey guys, welcome to VNTR Podcast, and today we are hosting Michael Terpin, joining us from Las Vegas. Hey Michael, welcome.
Glad to be here.
Yeah, let's start with quick introduction so that our audience can learn more about you.
Sure. So I have been a serial entrepreneur for the last 30 years, largely in technology and marketing. And I started first internet-based company, Newswire. It was called Internet Wire, and got funded by Sequoia Capital. And it's now called Globe Newswire, which is a $500 million division of Apollo. I also, in the early days of the internet, I helped with the marketing launch of Motley Fool and America Online Greenhouse and Earthlink and a lot of iconic .com brands. So when crypto came around, I sort of had seen this movie before and saw the potential of what's now called Web3 to be as big as the internet. And it made sense to me with Web 1 being all about the ability to publish and be seen by anybody in the world, and Web 2 to be able to communicate back and forth with anybody in the world. That was social media. And with Web 3, of course, started with Bitcoin and then all the other aspects that have sort of been built on top of the open source code, the ability to actually own digital assets.
Cool. Yeah, amazing. You have amazing background, and maybe we can start with your first venture. Like, how did you come up with that idea, and was it hard to raise money at that time?
You're talking first venture, meaning like in the 1990s, early 2000s. Sure, that was what originally was called Internet Wire. I was running one of the top PR firms in the country for what they called new media at the time. Again, launching the Motley Fool and other big brands. And well, we became big brands. They were startups when I worked with them. And that's also where I started investing in companies, because some companies that seemed very promising were not able to afford my agency's rates. And so I would invest in the company, and then they would be able to afford the rates, or I would simply take stock as part of my compensation. And, I think I did that with about 35 companies, and probably, 25 or more went out of business. But the ones that actually survived, included one that went 100x. And so that made up for all the losers. I had another 5x and a couple of, 2 to 3x's. And so by and large, that ended up being a profitable investment. And it also, gave me revenues, that I wouldn't have otherwise had I not taken a chance and taken part of my compensation in stock. And so that was sort of where I learned the model, because I did that in the early days of Bitcoin and crypto. I got into Bitcoin in 2012 is when I started dabbling with it, and then I went in head first in 2013 when I went to the Bitcoin Foundation conference in San Jose, which was the starting place for a lot of us. Bitcoin was $120. It had been $4 a year earlier, and it had gone through the ups and downs, and it settled in at about 120 after going from $11 at the start of the year all the way up to 250, and then down to 120. And people were wondering, is it going to keep going down? There were people who thought it was going to be under $50 by the end of the years. And I remember there was a debate at the conference, and Vinny Lingham, who's a good friend and a very accomplished person in both Web 2 and Web 3, um, basically said it's going to $1,000, and everybody was like, "What?" And he was right. It did hit $1,000, and that was really the beginning of what has now become sort of the 4-year cycle dynamics that I started studying there, and really formulated my 4 seasons of Bitcoin thesis in 2015 after it crashed, and I actually picked the bottom date to the day, and have been following and investing. Where I try to sell as much at the top as I think I've got confidence in, and then use that to buy back at the bottom. And with every cycle, it's gotten clearer and clearer what the dynamics are. There's always a little bit of variance. We're certainly seeing it this cycle, but with that variance becomes the 4-year cycle. It seems like every single time has so many naysayers that it's no longer kind of followed by the majority, and so that means that those of us who really track the cycles are able to profit at the expense of others who don't believe in them anymore.
That's cool. Yeah. So you also mentioned that you raised money from Sequoia and another kind of prominent VC fund. Just
Yeah, so I mean, obviously, the first money wasn't raised from Sequoia. This is going back to Internet Wire. I bootstrapped it. I came up with the idea in 1992. I bootstrapped it in '93, launched it in '94, and just paid for the really bootstrapped expenses on my own, and we slowly got it to where it was profitable. And when I looked to get angel funding was 1998. By that time, we were doing about, I can't remember, maybe $100,000 a month or something like that, and making a profit. And I realized that with the .com boom going on, and we had the name Internet Wire, that other people would try to copy us, raise a boatload of money, and probably be able to use that funding as a hammer against us to take our market share. And so I was like, okay, I better go out and raise some money. And so I raised some angel money first from people I knew, people I helped with their own .coms, and all of a sudden they're really wealthy now. And so I raised $1 million on an $8 million valuation. And then about a year later, when we used that money to, I think quadruple our revenues, uh, it was unusual for me to like be intentionally not profitable because I'm paying for growth, but the growth was paying off, and that's when I got Sequoia Capital, who I was referred to by one of our investors, and Hummer Windblad, who I'd known Ann Windblad for many years, to basically lead the round, and you know we ended up closing that round, and ended selling the company, I think 6 years later, for 35 million, which I wanted to actually keep it going longer because I thought we were just starting to hockey stick our growth. We hadn't even burned through our funding yet. But sometimes the VCs have different priorities than you do. It was like year 7 of their fund. They wanted to go out and raise a new fund, clean out the winners and the losers alike, and we were winners, obviously. And I told my board, I was like, I lost the board vote on this, but I told them it's like, just wait one more year and you'll be able to sell it at the amount. It was $35 million all cash. And sure enough, we sold the company, and the buyer flipped it 11 months later for 100 million.
yeah.
And then they ended up selling it later to our partner Nasdaq for 200 million, and then Nasdaq ended up selling it a few years later to its current owner Apollo for 300 million, and today it's about a $500 million division. It's called Globe Newswire. They changed the name again.
You gained some experience that you coached lots of startups, right? Like you invested in lots of companies. Do you recommend to bootstrap up to a certain point, or at what stage do you recommend to raise?
Absolutely. You should bootstrap until you have your product complete, till you have, I think that the more complete your product is, the more complete your revenue is. Having some revenue, you're going to get a higher valuation. So if you're raising money on just a concept, you're, going to be giving up a much larger percentage of the company. I mean, sure, somebody might go and fund the concept, particularly if you have a track record, and give you maybe a, pre-seed valuation of like, 7 million or something like that. But if you bootstrap, develop the product, have not just an MVP, but ideally a working product, and you've shown some revenue. Your first money might not be at a $7 million valuation, might be at a $25 million valuation. And so, that early money is the most expensive. I mean, one of my heroes is in the dot-com era. Actually, shortly after the dot-com era, they actually founded a company, I think in 2001 or 2002, was a company called Overseed, and it was founded by two young Vietnamese guys who just graduated at USC, I think it was, and they were bootstrapping, and they had a thesis of being able to go and write programs that would predict the profitability of domain names, and they were able to do it. And back then, they had a return policy that I think got changed because of the way that they exploited it, that you could go in and return a domain name for full money back guarantee after 7 days. So what they would do is they would buy tens of thousands of domain names automatically, test them to see what their ad response is, and say, okay, in 6 days, how much revenue did we get? If we extrapolate that out over a year, are we profitable? If they're profitable, they keep the domain. If they're not, they would return like 90% of these thousands of domains that they would buy every day. And that worked, and they bootstrapped it. I remember they bootstrapped it to the extent that a friend of mine who joined them early on, they had an office in the worst ghetto part of Los Angeles. It was like Skid Row. You had to literally walk over drug addicts to get to the office. They had a broken door that they didn't repair on their conference room. And I remember my friend broke a pair of scissors and said, "I'm going to go out and buy a new pair." And the CEO said, "No, do not spend any money. I will call my sister and she'll see if she has a pair of scissors." They never raised any money until they sold the company for $200 million.
Well,
Bootstrapped their way all the way to profitability. Not for everybody, but that was and now the founders are very wealthy and doing their next thing. And so bootstrap as long as you can. It's good discipline. I have a company right now that I've been advising. I'm not going to say who they are, but they ended up raising $1.5 million, and they ran through it in 8 months, and they went bankrupt because they look and say, "Gosh, you had all this money and you didn't even deliver a product," and it's a shame. But I always tell the companies that I'm investing or advising, the cardinal rule is you can't run out of money. If you run out of money, you have no options unless you're going to fund it.
and
You might as
in
well fund
terms,
it when it has a slower burn rate.
and at what point do you recommend to raise money from
When you have
VCs?
traction, when you have traction, and also when you have traction and maybe have competitors. I've got two sayings that I've used over the years. One is you can tell the pioneers are the ones with the arrows in the back, because if you're too early in a market, sometimes you're spending money before the market's really defined. I mean, the classic case was decades ago when a lot of money was spent on the standard called Betamax, and they lost to VHS for the video tapes before the DVDs came around. And the other one that I like is you don't have to run until you're being chased. So in other words, you don't have to go and plow a lot of money into the market before it's really developed. And a good example of that is, in the early 2000s, the first two people to develop blogging networks were Jason Calacanis with Weblogs Inc. This is way before he did the All In podcast. And the founder of Gawker, Nick, forgetting his last name now. And they were the Coke and Pepsi of blog networks. And they both made a point of telling people, oh, it's just a hobby. There's no real money here, because they were trying to keep people out. And they both became very wealthy on those networks. Jason sold to, I think, America Online for 25 million, which seemed like a lot at the time, and certainly a good exit for him. He went on to do all these other things like investing in Uber at $8 million, and that made him, extremely wealthy. And and then Nick, I think, got in some trouble with lawsuits later on. Nick Denton, but at one point, I think, he'd grown that into like $100 million entity, Gawker and Gizmodo and all the other brands that he had around that. So if you're not being chased, you don't have to go and raise money before anybody knows what the heck you're doing. So I think that the proper time to raise money is once you have traction and once you sense that there's competition in the market or opportunity for you to really use the money properly.
So you mentioned that you probably exited too early with your venture, and many entrepreneurs some fail to exit, some exit too early.
Again, we all made money. It was a profitable, exercise, exiting at 35 million, but I knew that there was a longer term growth potential there. But sometimes, if you're taking traditional venture capital money, you have to realize that they are judged on their IRR, their internal rate of return, and if they're making a 3x in 7 years, that's better than making, say, a 20x in 20 years, or at least they perceive the risk to be too high to go much longer than the length of the fund. And so you have to look when you're raising money and see, are your um, sort of intentions aligned with the VCs. So in other words, if you're trying to build a business for the next 20 years and they're like saying, we need to sell this sucker in 3 to 5 years, you're not aligned. You may have an angel investor or a corporate investor who's aligned with that. And obviously, we're here right now talking about the Web3 world, and there's two types of investments there. There's equity and there's tokens. And the tokens really became popular in 2017 because a lot of the equity had dried up when you had the sort of, the first, run up of Bitcoin that went 100x in 2013. And then you had this winter. Some very promising entrepreneurs had gotten seed round funding in, say, 2013, 2014. And then they wanted to scale up to an A. And the VCs were looking at very accomplished entrepreneurs who had a very good thesis and said, no, we're not seeing enough traction. We're not seeing how you're going to, take this public or sell to Google or whatever. And two that come to mind are, again, my friend Vinny Lingham, who I mentioned earlier. He had a company that was called Civic, and he'd gotten some, venture funding or angel funding to build it. And, he was not really looking at doing a token. He was looking at just being venture backed to have a product that would go and do your KYC on chain, so you only had to do it once, and you could just simply then share that with anybody. And there's a lot of companies doing that right now, but he was pretty much the first one to start going after that market in a serious way. It was called Civic, and the other one was let's see, it was the Brave browser, right? And the Brave browser was developed by the founder, one of the founders of the Mozilla browser, and he went out and raised money, and they both got turned down for A rounds, and so Vinny came up with a Civic token, raised about 30 million on a 300 million valuation, as I recall, and a similar amount of money raised very quickly. I think it was one day they raised 30 million for the basic attention token. And so that all of a sudden really proved the model of tokens being a very viable way to raise funding. And that was, I think, about mid 2017. And those two alone just really, I'd say, kicked off the frenzy for ICOs that, I mean, markets behave this way, right? I mean, it happened in the dot-coms, it happened in the ICO era, that, if a little bit is good, excess becomes great, at least the perception. And, by the end of the bubble, you had completely garbage tokens that had no product, not much of a thesis, and they were getting, $50 million in funding. And what happened was, you had this, everybody thought this would be the way of the future, that anybody with an idea could just simply put out a Ethereum address and say, we're going to go an ICO in a week, and we're raising $5 million, and they'd get it in, seconds oftentimes, particularly if they had any kind of, brand recognition. It was really good for me, running the top PR firm in the industry. We launched Ethereum, we launched, Tether, a bunch of other, early ones, Golem, Gnosis, who all popped. And I also started the first investor conference for crypto called CoinAgenda, which ran for 10 years. I have a new conference series now called Tokenize, that, has expanded from just, coins to tokenized securities and other tokenized assets, because it's a much broader field now in this era. But I remember that at the end of the 2017-18 bubble, it had already popped in terms of Bitcoin, hadn't quite popped in altcoins yet. And I held a conference in Puerto Rico in February of 2018. People referred to as now as Crypto Woodstock. And we got about 800 people, investors, to go and pay, I think we were charging $2,000 or $3,000 to attend. And the projects paid us $10,000 to be on stage and pitch our audience of investors for 5 minutes, and we sold out all 60 slots. So we got $600,000 in sponsorship money, and pretty much people paid it because literally you could get off a plane from the Ukraine, stumble up on stage, and say, "I do ICO for horses," and you'd get money. And it was
Yeah,
crazy because they knew that a couple days later you're going to be able to sell it for like 3x, no lockups, no KYC. Those were the kind of the Wild West days.
crazy times. Yeah.
Gosh, I miss those. And obviously the SEC came in a little bit later. They actually came in before. They came in 2016, I think it was, when they had the DAO, which
Yeah.
basically truly was a security. This wasn't like the kind of like, gee, it's a security because we think it might be that the Gensler SEC was accused, I think, quite rightfully, of going overboard, and the Trump administration now with Atkins is rectifying. But the DAO clearly was a security because they said, "Hey, we're going to go and have like a online VC where we're all going to pick things that we think we should invest in, and then you'll get returns from this." And they raised, I think, 150 million in a short period of time. It was the biggest ICO ever at the time. Obviously, a year later, you had $4 billion from EOS. Also did the marketing for. And that was probably the sign of the bubble top. But again, the bubble top was corrected very sharply. But these actually aligned perfectly with the 4-year cycles because, as I've often said, when Bitcoin gets a cold, altcoins get pneumonia, and these are very predictable cycles. And Bitcoin always recovers and goes to higher highs, significantly so. Most altcoins never recover. You have the altcoin market recover, but it's usually a new narrative each time.
Mm.
In the first 2012, 2013, having a run up where Bitcoin did 100x, nobody else came close. I mean, Litecoin went up a bit. And the narrative of altcoins back then, this is before Ethereum was even thought of, was to have better mining. So they're like, oh, Bitcoin's getting so hard to mine. Litecoin is more fair mining, and you had other ones, Devcoin, the Namecoin, Dogecoin actually came out in that era, and that was the narrative. It was like fairer mining. And then 4 years later, when you ended up having the run up in 2718, it was all about ICOs. And Ethereum was where most ICOs, 95% of them, were based on the ERC20 standard. You just give an address, throw money at it. And and that got overheated, and most of those never recovered, just like most of the better mining ones never recovered. Certainly cannot compare to the price of Bitcoin, even in US dollar terms. And so 4 years after that, then you had another narrative, which was DeFi, NFTs, and metaverse. And those are the ones that would go up. But the ones from, 4 years earlier, the ICOs, with rare exceptions like BNB and Chainlink, they never went anywhere. And even those, I think BNB is the only one that just keeps on hitting new highs every single 4 years. Even Chainlink.
There are like Filecoin, right? Kind of that are
Alcoa's in that
there.
era. They've been nowhere near their highs. So
Stellar.
again, if you look at any chart of any altcoin, if they're an old narrative, they can still recover a little bit during the high, but good strategy for altcoins is trade out your altcoins from the old cycle and reinvest them into something that's a new narrative. Bitcoin you can hold, and of course, I in my book Bitcoin Supercycle. There's the book. I talk about how to maximize your profits in Bitcoin by selling high and buying back low, which is, of course, the antithesis of the traditional, Michael Saylor, hodl forever, borrow as much as you can. And they're both good strategies, but mine provably has done better over time.
If we step back kind of to how to raise in the Web3 these days, right? It's kind of what works today for founders that getting started. How do they raise, and how do you recommend them to use the token versus equity?
Yeah, it's tougher raising now than it's ever been before because there's more projects, more noise. It's easier to launch a project. I mean, you can just go on Pump Fund, and there's 50,000 new tokens a day that are launched. So it's as bad, if not worse, than the height of the ICO frenzy when Melton Demirors, who's brilliant, writer and strategist, She wrote a blog post called Drowning in Tokens. It's worth a read. And it basically said that, she had started in the industry, in the investing industry as an oil and gas analyst. And she said the one thing she learned from the oil and gas industry is that you cannot increase demand by simply increasing supply. And that's what the O's tried to do. Hey, more tokens, everything goes up. Doesn't work that way. There was a flight to quality, and then just a big broad-based crash that even took down the best things. Just like in the dot-com bust, even Amazon and eBay got crushed. They returned because they had good business models, and obviously BNB and Chainlink and other ones that had held on to their money. I mean, the best ones knew when to go and convert their Ethereum treasuries that they got at $1,200 Ethereum back to stablecoins or cash, during the crash so that they weren't, selling $80 Ethereum until there was nothing left. And then, if they were really savvy, they would then buy back into Ethereum at the bottom of the market. Similar strategy to what I recommend in Bitcoin.
But so let's say a new good company, right, with good team, good idea. What do you recommend them to do to raise money today?
Well, these days, you know, you don't need a big team, right? My most successful startups that I've invested in and that I'm advising, they're one and two man teams, and they're getting traction versus some of the teams that went out and hired 10 people. And the reason why people go out and hire 10 people is they don't have a solid enough core tech guy at the helm. If you've got a real rock star, I can think of two of my best portfolio company. In the one case, they've been around for a cycle, and they've had to pivot a couple times. 4 years ago, they had about 15 programmers that they were, happy that they were kind of getting a deal on them because they were all from the Ukraine. Now they have zero programmers. They have the CTO, and he's doing everything using
Yeah.
Claude and other AI programs and vibe coding. And vibe coding, Claude, etc. It's a whole new world. The winners this cycle, I think, are going to be the ones who are very efficient and are able to go and have a single tech coder that just basically uses AI and doesn't really need a lot of resources because their programming staff is their AI. And then ideally, it's rare to have the tech coder also be the businessman, right? It happens. Steve Jobs was the business guy, and Steve Wozniak was the tech guy, right? And they were a great team. Bill Gates was both, right? Michael Dell was both. I mean, Mark Zuckerberg was both. So it's rare, and those people become billionaires, right? Because I think the stat I had heard somewhere was that something like 90% of workers are basically, good to whatever their level of skills are at operations, and they really have no vision. 9% are really good at vision, but they're sloppy with their operations, or they just, a lot of creatives just, can barely tie their shoes while they're making their great art. And it's maybe 1% that are, visionaries that are also good operators. I'd like to consider myself to be in that 1%. And certainly the people who have, really been solo founders and have made an impact would be in that category. But if you feel you're really good as a founder at business, find a great coder. Don't just go out and hire a team of 10 people you don't understand what exactly they're doing. That's a model for disaster. I've seen it happen over and over again. You get one person that says, "Oh, I'll hire 10 other people," and you're not really steeped in what they're even doing. That's a recipe for disaster.
Yeah.
You need to go and partner with a visionary founder if you're not one already, who has a kind of an advantage over everybody else because you're aligned on the business model and they know how to code it, and they know how to code it with AI and not with a staff of because that's where your burn's going to go, right? You're going to be like every month it's like, oh, we need another $50,000 to pay for the coders, or you need another $20 to pay for the AI overhead.
And in terms of business models in Web3, it's also kind of changed, right? Because before that, you would review the token economics, and how do you see what?
Well, token economics is still important.
Yeah.
I'd say these days there are fewer projects that have no equity component or just, I mean, the ones that are rightfully just selling tokens are the ones that are a protocol, right? If you're a protocol and you don't have any, you know, profit model. You're just a decentralized protocol. You're an L2 or you're an L1. You're a DEX, and you don't really have any kind of for-profit company that is kind of maximizing. The two models are either you're completely a token economy, in which case the historic model, particularly in the time that there was all this fear of the SEC, which is largely abated. That you basically go out and you get a foundation and like Cayman or Liechtenstein or whatever, and you set it up there. And even though, you also have some issues of getting around, like, being mainly Americans, if that's the case. And then, you spend a lot of money on lawyers just trying to figure out how to have a structure that the SEC is not going to come after you. And, and again, then you had the whole debates on, like, the Howey test versus the Hinman letter. And are you sufficiently decentralized and all this stuff, right? And these days, I'd say most projects are not protocols, right? I think we've had probably sufficient protocols for the foreseeable future. It doesn't mean that there won't be some breakthrough protocol that comes. And certainly, I see new protocols that are asking me for funding every day, and I just don't think it's a good time to launch a new protocol when we still already have massive, like, struggles between the EVMs and the and Solana and other ones. And so I think that you know most companies are going to go and have a, if they have tokens at all, because again, there's obviously I'm seeing an increase in for-profit companies that have no token, right? They're just simply, oh, we're going to go and create a company that does regulatory software or that, creates software to, connect the banks and fintechs to stablecoins, and we don't have a token. And these are usually people who come from the TradFi industry. They don't really understand why you would need a token. They think it's better and more compliant to not have a token. Those are not going to be the big winners. I mean, you might have one or two that do really well. Obviously, like someone like Revolut, is an early fintech that did fabulously well without a token. Stripe, the same. I met both of those teams when they were like in the crib, when they were just like asking for their seed round. And I wish I'd given both of them seed round money, right?
So why did you pass on them?
I mean, on Revolut, it was because the founder barely spoke English. I thought he had some good ideas. It was just like one guy with an idea. And, it was like saying, I'm going to do cloud-based money. And I was like, well, why don't you do it with Bitcoin? And like, he was just like, no, cloud-based money. And he explained all this stuff to me. And, I met him at a lunch, so it wasn't a formal pitch to me, but I didn't think he was going to go anywhere. And I think he's worth $10 billion now or something like that. So obviously, Stripe, I met them in Ireland. I actually was working, doing the marketing for a conference called Bitcoin Ireland. I think it was 2014. And they were just like, young, I think they were probably 21, 22 years old at the time, brothers that, again, were starting a fintech, which I was not that interested in, non-crypto fintechs. And obviously they're worth 20 or $30 billion now. And, it seemed like a very hard market to crack. Oh, you're going to go up against PayPal? Good luck, right? And obviously, it was just, you have to look at the determination of a team. I mean, I think in both cases, you just had very determined teams that just would not accept failure and just like, did what it took to go and have 24/7 meetings and deliver their products on time. And of course, with Stripe now, they've been very crypto friendly and they're now, kind of launching their own EVM token called Tempo that I think just raised 500 million on a $5 billion valuation for an EVM because they just figure, oh, well, if they're partnered with Stripe, they're going to be the stablecoin that everybody uses. And, we're right now in that era where TradFi is going to go and try to, kind of raise money in crypto by basically saying, we're TradFi, we're going to crush everybody. And that didn't work out the last time because you'll recall that, during the ICO era, there was also a number of projects that basically were like, we think it's like, there's no regulatory clarity. We think we should build blockchains that are private. And so you had Hyperledger, you had R3, you had
Casper, like they had an
Casper was,
instance.
no, Casper was public. Casper was a public token. It traded on exchanges. No, these were private blockchains. They were
Mm.
built by the banks for the banks, and they all failed. There was another one that J.P. Morgan did begin with a C. I can't remember his name right now, but they ended up finally just giving up and giving the code to Consensus and invested in Consensus and said, "Look, you guys know what you're doing better than we do about blockchain." And so that was basically a failed experiment to basically say, you know, we can go with our big TradFi guns and just crush crypto. And, it's sort of like in the early days of the internet when you had intranets, right? So you had a lot of the big companies saying, the internet's too scary a place and we're afraid of hacks and things like that. So we're going to build our own internet. We're going to have the Walmart closed garden internet that you have to sign on. And it's like, and then they just realized that like, that made no sense at all. People wanted to be on the internet. They didn't want to have to learn a new system every time they went to a new company. And of course, the companies were like, gosh, we need to hire an awful lot of programmers to build our own internet. Every time there's a upgrade to the real internet, we have to go and figure out how do we add video, how do we add audio, et cetera. So everybody, eventually ended up just building stacks on top of the internet. And so, you would have instead of an intranet, you would basically just have a, kind of a corporate website that was password protected or whatever.
Yeah.
And these days they build CK on top of it, et cetera. But open source almost always wins because it's more efficient. It allows so much more capabilities, and I think that open source, which is crypto, will prevail over closed source, which is the bank's private kingdoms.
And what is your perspective on all these stable coins? Like everyone is trying to launch their own stable coin. Do we need that many stable coins?
We'll see if it's a winner take most, guerrilla game scenario. I mean, right now, Tether is still, 80+% of the stablecoin market. And USDC is, about 20%, I think. And everybody else is like, combined is like single digits. But, you do have certain use cases. Um, I'm an investor through a fund of mine in the Metallicus, which is a company that is building stable coins for credit unions. And they just launched the first credit union stable coin. It was a stable coin for, I think it was St. Cloud a bank or credit union. And they've got like dozens more that they're onboarding right now. And the idea is that you can go and tokenize the bank deposits as well as you can go and buy T-bills and then use those T-bills the same way Tether does to basically, it's a value to someone who's already got a credit union or a bank, a small regional bank or something, to be able to go and have their cash and their stable coins in the same place, right? Because that way, all of a sudden, I mean, right now, if you have a bank, I mean, I've got an account at like, JP Morgan private bank. If I want to go in and get stable coins, I have to go and like, um, wire money from my, my bank to Coinbase, uh, and then they'll convert it for a fee, and JP Morgan is going to charge me a fee to wire it out. Um, and then actually, I think I have that wrapped in, but still, most banks will charge you a fee to wire out. And then Coinbase will charge you a fee to convert into stable coins. And then they have to wire it out, right? I mean, it's just like it's time and it's energy. And then you get another fee if you're then buying Bitcoin with it, right? So if you have a bank, and this was the whole purpose of Custodia Bank, which, my friend Caitlin Long, who's a pioneer in this space, I mean, she sued the Fed and she's got a state license for Custodia Bank, and I believe she's got a number of patents on tokenized bank accounts. So it'll be interesting to see whether those get held up, and whether a big bank acquires her, or whether they sue her, or she sues them, or whatever. But still very early. But tokenized bank accounts are definitely something that the banks are going to do, where they'll say, okay, you have $100,000 in your bank account, you can go and instantly convert that cash into stable coins, and we'll just drop in your wallet. I'm sure they'll have like, okay, here's our, KYC. This is the only wallet we accept or whatever. But that's the future. I mean, Arthur Hayes did a post not long ago, and I saw he also discussed this recently on another podcast with Tom Lee about it. It's inevitable that the big banks are going to go to stable coins and tokenization because I think Tom Lee said that, I think JP Morgan's got 300,000 employees. If they basically went to stable coins, they could get away with like 20,000 employees.
Do you see them adopting USDC, or they will launch their own tokens?
They'll do their own one.
Their own, okay. But then
yes.
you still.
JP Morgan has already done that.
Okay.
Why would they not? They're going to tokenize their own bank accounts. Why do they need to cut in USDC? Because again, USDC and USDT have a big advantage if you're using it to just trade crypto. This is not what is the purpose of most people wanting stable coins. They want to use them as payments, right? And so merchants will accept any stable coin because they can convert it to cash. And as more and more banks, the first big bank to do this is just going to be everyone's going to do it then. So in other words, you're going to basically, we'll accept any stable coin and then convert it, and they'll just, Wells Fargo is going to have to accept the JP Morgan stable coin, and they'll just bridge it out. And you'll have, just like Zelle, you'll have a banking consortium, and maybe they'll go in and like merge and have a Zelle coin or something like that. But the banks want to control their own stuff. That's why they did R3. That's why they did the other one, begin with a C, it can stable Orient or something like that. And I don't see them going and saying, oh yeah, we're going to give the business to Tether or to Circle.
Yeah. And nowadays there are so many digital asset treasuries that for Bitcoin treasuries and other token treasuries. How do you see kind of why there is need for these digital asset treasuries?
Well, I mean, the need has typically been for consumers, typical, retail investors who recognize the value of Bitcoin as part of their portfolio, but have been afraid to go and, self-custody, or were turned off by the amount of complexity that it took to get an account at Coinbase. Typically, most of the U.S. exchanges have the same, if not worse, onboarding than going to a new bank. And so they're like, well, I already have the Charles Schwab account. If I can go and buy MicroStrategy and that, mirrors the performance of Bitcoin, or an ETF that exactly mirrors the performance of Bitcoin and MicroStrategy, you're kind of doing Bitcoin plus leverage. That's something that people are like, oh, I can go and use my existing Charles Schwab account, my TD Waterhouse, my whatever. And now they're opening it up to being able to do your IRAs for Bitcoin. And I think you already could do sort of, different stocks into IRAs, self-directed IRAs. So I think that there's going to be a big move in the next, 5 years, where your typical portfolio company, your typical IRA is going to probably, right now I'm guessing that less than 1% of IRAs have any kind of Bitcoin or crypto exposure. And probably, maybe another 1% might have some stocks that are like MicroStrategy or something. I could see in 5 years that being, 5 to 10%, if not higher. And that'll have an effect on the price of Bitcoin, right? I mean, if you're talking about, I forget the number of trillions of dollars that are in IRAs, it's in the trillions. And obviously you have 10% of them, buying Bitcoin either directly or through an ETF or through an investment into MicroStrategy and other digital asset treasuries that then have to use that money to go out and buy Bitcoin. And the Bitcoin treasuries, for the most part, don't sell, whereas the ETFs, are basically you can buy, you can sell. So the ETFs will act more like retail than they will like institutional, whereas the DATs will act more institutional because they're buying and holding. Now, will they be allowed to buy and hold when the down market happens and they get lawsuits against them? That was the very first digital asset treasury company wasn't MicroStrategy. It was Grayscale. So they did a trust for credit investors in 2013. I remember when Barry opened it up. I was at his opening party when he founded DCG, and that was one of his first products was the Bitcoin Trust, where you could go in. Bitcoin was about $100 at the time. You could go in and give $50,000, $100,000, pay a small management fee, and they would hold the Bitcoin for you. And then about a year later, they ended up saying, "Oh, we're going to go and allow you to convert this into a public stock called GBTC." And that was a good trade for a while because you could come in as an accredited investor, you know, buy at par, whatever the price of Bitcoin was, wait a few months. I forget if it was 6 or 12 months you had to wait, and then just simply convert it at par into GBTC by contributing the Bitcoin in kind into the GBTC vehicle. And it was trading at a 30% premium. So you could then go and, sell your Bitcoin effectively at a 30% premium, take that money, reinvest it into the trust, and just repeat. And you could be making 30% a year that way. It was good while it lasted. And then all of a sudden they said that they wanted to be an ETF. They kept getting turned down by ETFs. And, a lot of naysayers were saying, we're going to sue them. We need to break this up. They're going to just like fritter away. They're going to have to start selling Bitcoin to pay for all the legal expenses. And, there's a big move to break it up. And so this premium all of a sudden became a discount. And for several months at the bottom of the market in 2022, GBTC was going at a 50% discount. So you could literally, when Bitcoin crashed down to 15 grand, you could have basically got $7,500 Bitcoin by buying GBTC. It was risky because they could have, blown up in a big bankruptcy and forced liquidation, but still get the Bitcoin was the idea. And so smart money went and bought that stock and did very well because as soon as the ETF came out, the price of GBTC effectively doubled.
Oh, but what do you think about all these dots that are, like there is a Ton one, there is Solana, there is like a mix of kind of
Sure.
portfolio?
So, I'm on the board of Alpha Ton, which is one of the Telegram Ton digital asset treasuries. I mean, I think what differentiates us a little bit is we also buy companies, profitable companies in the Telegram ecosystem. So we're not just just like, buy the asset and sit out and don't do anything. I think those companies are going to run into some regulatory issues in terms of just being, judged to be an investment company instead of an operating company that, has a thesis with a big treasury and the asset they think is going to go up over time. And, I mean, for the most part, a number of these companies, particularly on the Bitcoin side, have gone way up and then they've gone way down. And Tom Lee, who's one of the ones that's gone up, basically went out and said, "Dats are dead." Anything except for him and MicroStrategy. And of course, they're not dead, but I think that they're still going to probably have a little bit of a comeback during the rest of the bull market. But I do feel that some of the ones that are improperly structured, like they're relying more on pipes than they are in what they call ATMs, um, are going to have a moment of reckoning when all of a sudden they start trading significantly under NAV. So if they're right now, some of them are trading right at NAV, that we're trading at like 3, 4, 5 times NAV, and so the investors that went in at 3, 4, 5 times, they're going to have class action lawsuits against the ones that are now trading under, and then it depends how good their D&O and E&O insurance, they're very expensive, is how the precedence is in any of these court cases prevailing, and what that means, in terms of if some of these are forced into liquidation or bankruptcy, there should be a buyer, right? Because they've got Bitcoin on the balance sheet. And so you may end up having, and I've projected this for a while, that, that's, kind of fuel the run up, because if you indeed have a number of, additional DATs between now and the end of the year announced, because for a while there, it seemed like every other day somebody was announcing they were going to put $500 million into this, $1 billion into that. And, as the one congressman that said many years ago, billion here, a billion there, soon you're talking real money. And I think that's the case with the DATs too. And, I think the stat I saw, I'm trying to remember the exact number, I think we're over $100 billion right now between all the DATs. I mean, half of that is MicroStrategy, or a little bit more than half. But that's a significant sum. If it keeps on going, it may end up getting close to the size of the ETF market. And so those are all buy pressure right now. and there'll be sell pressure when, retail inevitably changes sentiment and, they go on TV instead of hearing about all new time highs. They hear about like fear and panic in the Bitcoin market. Oh, it's down 30% in the last 3 months. Is it going to zero? This happens, every 4 years. And predictably, the media just follows the horse race and they just extrapolate the best and the worst. And that sort of fuels, nervous, newbie behavior. First cycle newbies usually drive the bull market and they drive the bear market. And this time the newbies are not going out there and filling their coffers with Dogecoin like they did 4 years ago on Robinhood. They're going in and they're buying MicroStrategy. Your newbies right now are not largely opening up Coinbase accounts and listening to YouTube podcasts about crypto. They're looking at CNBC and they're buying with their Charles Schwab account, with their IRAs, with their 401ks.
Let's shift to communities, right? Like you build various communities, you build conferences. How do you utilize these communities by yourself?
So I guess the first one I had a hand in building was BitAngels. David Johnston and I met at the first Bitcoin Foundation conference and decided that there needed to be an angel network for Bitcoin, and so we called it BitAngels. And introductory meeting, our like sort of a just first membership meeting at the conference, and we just put a note out on Reddit, hoping to get 5 or 6 people. We got 35 people to show up, including Vinny Lingam, Quinn Jesus, Roger Ver, some other very prominent people. And by the end of the week, we had like I think 60 members, and by the end of the year, we had I think 500 or 600 members. And so, in the early days, it was just sort of we would go in and do this is how old it was. It was GoToMeeting. It wasn't even Skype. And we would have biweekly calls where people would just call in and they'd listen to pitches from all over the world. I decided that I wanted to add physical meetings. I think it was around maybe 2017 or so. And so we started doing physical meetings in chapters. We've been doing that for a number of years. We're now, I think, 35 or 40 chapters that basically do BitAngels meetups. We never charge for companies to pitch. And they just they're chosen on merit by the city leaders, and we at Global also will recommend ones, and the city leaders basically do it because they want to build community, and they're oftentimes break even or just losing a little bit of money if they're just doing it on their own. Otherwise, they'll maybe get they'll get a free space, they'll get a law firm or something to buy lunch, and so it's not that costly. And it's never been about like making a big boatload of money. It's always been about deal flow, finding the best new companies to invest in.
So basically, as a network, you curate different companies, and you're co-investing as a group into this.
And again, it's not co-investing as a group because it's not a structured fund. Everybody makes their own investment decisions, but they do have their fellow angels to bounce things off of, so they'll go in and there'll be like 2 or 3 people say, I'm interested in this, and they'll chat amongst each other just informally. And you get usually, I mean, it's rare to get only one investor from a BitAngels into an investment. In fact, the very first ICO, which was Mastercoin, was like 90% of the funding came from BitAngels, which is only $600,000.
That's cool. And in terms of conferences, why did you launch conferences, and is it revenue generation or also deal flow?
Yeah, I launched CoinAgenda in 2014 because, as BitAngels got more popular, people wanted to meet the other BitAngels in person. And so we would hold meetups during other people's conferences. And we had a really big one. I think must have gotten over 100 people. We did a little party during the December 2013 Inside Bitcoins in Las Vegas. And that like, very, I mean, it was height of the bull market, right? For 2013. That's when Bitcoin had gone from like, $100, it dropped down to 66 during the summer, and it went up over $1,000. I think it went to $1,200 like a week before the show. And so everybody was very bullish. Where's it going? $2,000, $5,000. And obviously that was the top. And, but it was very, very bullish. And, we then decided to start having BitAngels breakfast, BitAngels parties. We get separate sponsorships for that. And then I'd say the turning point when I decided to have my own conference was we were all supposed to meet up for breakfast, a BitAngels breakfast in New York during Inside Bitcoins New York, where Mastercoin did its big. Not Mastercoin, MadeSafe. Mastercoin had already gone out. Horrible rainstorm in New York, and everybody was stranded. They couldn't get to the thing. And I was just like, you know what? I think I need to do my own conference. And that's when I came up with the concept of CoinAgenda. And by the end of the year when we launched it, the first one was in October of 2013, which is pretty close to the end of the bear market, but we still had a couple more legs to go down. We had dropped below $300 from a high earlier that year of 10, 11 months earlier of 1100, 1200. We had dropped over to down to 300. And I remember putting out an announcement that we were going to hold it in the Mike Tyson mansion, and and also have the opening party in the Hugh Hefner suite at the Palms, and just I wanted to just go tricked out, every luxury kind of high end thing you could think of to draw a crowd. This is before I bought the Mike Tyson mansion, which I'm in right now, but I rented it from the prior owner, and he actually had a sponsorship. Um, and I ended up getting the Wall Street Journal to write a piece about it, and it said something to the effect of Sin City Bitcoiners party while Bitcoin burns. They just saw Bitcoin is going to zero, and we're fiddling on the roof and having parties, and Bitcoin continued to go down. I mean, I actually charged a number of the people in Bitcoin, so they were paying us $1,500, and that was about like 5 Bitcoin back then. So nice upside. And $600,000 today. It continued to drop, and I think the low was 117 in January. And I remember actually this was at my conference, but I remember there was I think it was an after party at the North American Bitcoin Conference, which was very bullish a year earlier in January of 2014 and extremely bearish, and everybody giving up and this and that. But the hardcore people, we had some of the biggest industry leaders at this thing called the Bitcoin Supper Club that Brock Pierce and Matt Rozek did. I remember we held it at the Versace mansion, and I took a picture and I posted it, and I said, "If this is Bitcoin's last supper, because the price just dropped below 200, let it be at the Versace mansion." And of course, obviously, nothing from there. And today it's 100 and $15,000 per Bitcoin, not 200. So that's kind of I think I built it to sort of build an influence community, and I mean BitAngels has never been a profit center, and conferences are very hit or miss. I mean, we did really well in the top of the ICO cycle. We then basically lost money in the bear markets, and then we still kept it going, and then made money again in the 2021 bull market, and then sort of just scraped by and kept things going in the 2022 bear, and then I kind of did my swan song for CoinAgenda, retired the brand in 23, and then I relaunched a new brand that was less about coins and more about the broader category of Web3 investments, including tokenized stocks, tokenized securities, tokenized real estate, because that was really what a lot of people were like, oh, I'm not interested in speaking at a coin conference. I want to talk about tokenized securities or whatever. And so I created series called Tokenize, and we hold that 4 times a year now. We do 3-day events in Puerto Rico, part of Puerto Rico Blockchain Week that I started with Brock Pierce back in 2017, and then we also hold an annual event in Las Vegas. We usually sort of attach ourselves to some other conference. For years it was Money 2020, and now it's the Bitcoin conference that David Bailey puts on.
Yeah, that's great. And can you talk a little bit about your book, like Bitcoin Supercycle? Like, why did you? Yeah.
That's my book, Bitcoin Supercycle. It's published by Skyhorse Publishing, 360 pages, lots of charts and graphs. It's distributed by Simon & Schuster, and it's available on Amazon. So I wrote it out of the frustration of telling a lot of very intelligent investors in other categories, real estate, tech startups, gold and silver, Bitcoin, when it was $100, when it was $66. I mentioned the book that I spoke in front of the the New York Angels, traditional, like, investors in tech startups. And, they would think nothing about writing a $50,000 check for a startup that probably had 2% chance of making it because they liked the founder, they liked the thesis, part of their overall portfolio. And I talked about Bitcoin being something that was going to change the world. It was $66. I said I think it's going to be $10,000 by the end of the decade. Of course, it was 20,000 3 years prior to the end of the decade, and not a single person bought. And the only comment that I got was after, and I got no questions. At the end of the first break, a gentleman came up to me and said, "Son, I'm a retired economics professor at Princeton, and I've looked at this Bitcoin, and it's only good for, drugs and prostitution. I suggest you run away from it as fast as possible." And that was, the general perception without anybody having bothered to read the white paper. I was frustrated by the fact that so many, otherwise intelligent people said, this is not Bitcoin for dummies, it's Bitcoin for misinformed investors. And so that was the reason to write it. I spent the first 5 chapters going into the reason why Bitcoin's been the best investment for the last 15 years and why it's going to continue to outperform stocks, bonds, gold for at least the next 20 years. And then the middle portion of the book is about, the bulk of it is about my thesis, the 4 seasons of Bitcoin, where Satoshi in the white paper said that as long as the amount of new Bitcoin bought exceeds the amount of Bitcoin mined, new Bitcoin mined, the price has to go up. It's basic math. And yet it doesn't go up in a straight line, right? So first halving price was $12.70. 4 years later, the second halving was $670, 50x. The third halving, it was $8,700, about 12x. And then this last halving, it was 63,900, about, 7.5x. It does not go up in a straight line. In fact, that's where all the major volatility is, right? So, between the $12 and the 670, it went all the way up to 1,200, and then it went back down to like 171, and then it ended the cycle at 670. So that volatility I've studied extensively, and I created this thesis called the 4 seasons of Bitcoin. And that's because I noted that there are 4 distinct behaviors that happen in the same order every cycle. And the first one is what I call Bitcoin Spring. It starts the day of the halving and it ends the day that you pass the all-time high of the prior cycle. That is where miners go from being profitable to unprofitable in one day. You would think the price goes down. It doesn't. It actually stays flat because for every miner that sells Bitcoin, which is less and less every cycle because they typically have better funding now, somebody's willing to buy it because they look at the history and say, oh, it's going to be worth a lot more in 4 years. I should buy it now that it's cheap, now that it's, dumping. And so that tends to regulate it. And then eventually, after a couple of months, it starts creeping up. And when it creeps up to the all-time high of the past cycle, that's the first day of Bitcoin summer. I think I'm the only one that really has been talking about this. That day is a wonderful time to invest. Obviously, the best time to invest is at the bottom of the market when everybody's blood in the streets. But on a daily IRR basis, you can't beat investing the first day of Bitcoin summer. The day that it hit $30 in 2015, which was the all-time high for the pre-halving cycle, within a couple of weeks, it was $250. And then most cycles have had like a lull in the middle. They call them double bubbles. 2017 it was a lot less pronounced. It was a little bit more straight up, but there's still a little weakness in the summer. And then they all end with these parabolic pumps at the end. Less crazy each time, right? The first time you literally went from like $100 to $1,200 in about 8 weeks. From the end of not even 8 weeks, about 6 weeks, from the end of October to the start of December. 4 years after that, you ended up going 30x for the halving to high. But again, the day that you hit 1,200 from the last cycle, it ended up going up, doubling within a couple of weeks. And then it was more slow, kind of going up. I think that one it was still about $2,000 at the end of July, and it was $20,000 in December. So that one was much more, kind of slow to start, and then again parabolic at the end. And this last time, 2020 to 2021, the number you needed to beat was 19,800 to start Bitcoin summer. And when that happened in December of 2020, within 4 months, you were at over $60,000. So 3x in about 4 months. Then you had a double bubble, so you ended up going down during the summer, and then you ended up going to a slightly higher amount in November. I think it was 67,000 and change. A number of people have said the cycle is broken this time because we had an all-time high a month before this halving, and they said, "Oh, well, the cycle's broken. We've never had an all-time high." That was kind of an anomaly because, in my opinion, and I talk about this in the book, the all-time high um, during after the third halving was suppressed by the negative macro that the Biden administration and Gary Gensler and the rapid rise of interest rates in 2021 all compounded to sort of put a chill on the crypto market. So we should have gone up 10x in terms of just the diminishing returns of 100x, 30x, should have been 10x. And instead it was only, I think, 7.8x. That still has some pent up demand that when they finally passed the ETFs, there was a pump that took us to 73,850, but it went down a month later at the halving. The halving has always been 4 out of 4, the perfect price of Bitcoin. I call it the Goldilocks price. Never been oversold. It's never been overbought. And if it indeed was a breaking of the cycle that it was what I call Bitcoin summer happening before Bitcoin spring, it would have shot up right away, but it didn't. It went down at the halving. And I feel that I've proven the point because typically, so this past cycle, you typically shoot up when you beat the old all-time high. Well, that all-time high from the last cycle, because again, you can't have this cycle's high before the halving. That's by definition last cycle. And so nothing happened when we passed the 2021 high of 67,000 and change. But the day that it passed 73,850, it went to 100,000 within 3 weeks. The fourth thing then is Bitcoin fall. Bitcoin fall is the most important season. If you can judge the first day and the last day of Bitcoin fall, you make a fortune because you sell on the first day of Bitcoin fall. That's when the bubble pops. That's one to figure out. You have a number of things that I talk about in the book: unchained analysis, fear and greed. It's always been over 90% greed when the bubble pops, and it's always been below 10%. Greed, like 90% fear at the capitulation at the bottom. And these are repeated every time. We have been nowhere near 90% greed this cycle. The highest we got was we blipped one day to about 70% greed recently when we hit the current all-time high of about 126,000. And then Trump tweeted and about China, and then it dropped. And so right now, I said in my book that the all-time high for this cycle will be about 3x plus or minus macro factors. And the macro factors are typically about 20%. So if the Trump tweets that destroy the market keep on happening, we're going to reach a high of about 20% below its potential or its average of 3x, my projection, which would put us about 154. I do not see us, as many people say, that 127 was the high. We're going to go down to 30K from here. I don't see that.
What is the lowest it can go down?
Well, I believe that so the Bitcoin fall has typically been about 1 year. Last time was a year to the day. 4 years before that, it was a year minus 3 days. So whenever the bubble pops, and I think it'll probably be in December, let's say it goes to 150, that means it'll take about a year to then drop to about 50. So we've had diminishing returns and diminishing losses. The diminishing returns were 100x, then 4 years later was 30x, then 4 years after that it was 8x, and this time I'm projecting 3x plus or minus macro. So 3x the halving from last year, which is 63,900, gives us an average to shoot for at 193K. Seems right now that I'd be laughed at if I said it's going to be 193K at the end of the year, but stranger things have happened. If you look at all the prior bull markets, they always end up with this, kind of breathless run up. I mean, this week, a couple things might happen. If Trump says, I have a deal with China now, what do you think it's going to do to the market? And if the Fed tomorrow goes and says, we're going to cut 25 basis points and we're going to continue cutting until we see, whatever. And we know that Powell's term is going to end in May. And so I think the market's going to front run that, assuming that we're going to keep cutting after he's out. And I believe that if as long as Trump doesn't continue his Twitter warfare of just
Yeah.
dumping markets just as they're starting to recover, and then we should you know I think worst case we'd get to about 154. That's 20% below the 3x of the halving, and we still have a shot at going over 200. I mean, it's not impossible. I mean, the average return in November's over, I think the last 10 years or something was over 40%. It's the most bullish month. They say October because that's usually been a double digit returns. This time we're not going to probably have double digit returns unless we have a hell of a pump this week. But, all we have to beat to be up slightly from September is about 114 and change. So if we end the month at 115, which is about where we're at right now, we'll be up like 0 point something percent. I think by Friday we could be in the 120s. Again, if they announce at least a lack of like warfare with China, the trade things, if they announce that they're working toward a deal and all looks good, and the 100% tariffs are not going to happen, and I mean they're kind of like messaging that that's going to be in the works. Now, of course, Friday's options expiration, which is always very volatile. The last couple of times it's been volatile to the downside. Options expiration do not always go down. Sometimes they go up. Sometimes you have a short squeeze. I mean, if everybody right now is betting that it's going to tank, the market will punish those, that bet the wrong way. And so you could see a short squeeze take us into the mid 120s, even 130s in the next few weeks.
So what gonna happen if, like, again, we got to the maximum? If it goes down to 50, all the DATs, all the ETFs, and the market, what gonna happen?
Well, I mean, you have a lot of pain during the bear market, and right now the common wisdom is that we're done with bear markets. There's never going to be a bear market again. I mean, the ETFs are saying this, the big banks are saying this. Mike or Matt rather, I forget his last name, Hoggerty or something like that, from CEO of Bitwise, has been going all over the podcast saying that, volatility is a thing of the past in Bitcoin. It's now going to look like gold. It's going to just slowly go up, maybe have small pullbacks, nothing more than 4 or 5%. And that's just wrong. I mean, gold is doing that because it's a 6,000-year-old asset class. It's like, it's 80% controlled by institutions, whereas Bitcoin is 80% controlled still by retail and OGs, et cetera, and whales. And you're just not going to have the last halvings, you had 85% drop after the first bull market. You then had an 83% drop after the second bull market. This past time you had a 75% drop. You're just not going to go 85, 83, 75, 5, right? So whatever the high is, I'm projecting that we'll have between 60 and 70%, which will still be the best we've ever done in terms of like, minimizing the amount of volatility. But I just don't see it being like 10 or 20% drop. So if the bubble pops at say 150, I see us dropping down to 50, 60,000. And I think that when we drop under 100, you're going to see some people panic. When we drop under 75, you're going to see more people panic. And then, you're going to have capitulation probably when it dips under, whatever the ultimate. And again, it's not a coincidence that a lot of really bad things like bankruptcies happen during the bear market. Most people, and certainly all the politicians, are like, "Oh, see, fraud, FTX. We got to regulate crypto more. We have to stop things. Protect investors. Blah blah blah. Put the banks in charge. Whatever." Right? That happens every crypto crash. Which, interesting enough, and I think Satoshi planned it this way, all the halvings have been in presidential election years. All the crashes have been in the midterms. And so that becomes a big midterm meme. It's like, oh, look at these bad Republicans, who let you buy Bitcoin. I mean, right now it's so funny that the Democrats literally their messaging is Bitcoin bad, Bitcoin MAGA, Bitcoin bro. I think I saw it called by one person bro currency. And and they're all like, you must stop it. You must impeach Trump and like stop Bitcoin. And it's too bad because I mean, if the Democrats are supposed to be for the little guy, is going to get ahead not by investing in T bills, but and putting money in their mattress. looking for like a decreasing amount of entry level jobs with AI, which they're trying to stop that too. But by basically embracing the new world, embracing AI, embracing digital currency, and particularly, if you can go and cobble together your savings for your family and get one Bitcoin, and it's always easiest to get in the crash. Maybe you can't afford it at 15,000 dollars a day, but at 50,000, if you start saving your money now, you might be able to buy one. And one Bitcoin, when it's worth $1 million, you'll be very glad that you bought it at 50,000. I mean, the number of people who own one Bitcoin or more, it's called, whole coiners, hit a high right after FTX because you could buy one for 15,000, right? And I think we briefly got to about 1 million. I think it's 900 and something thousand. You can see this on chain wallets that have at least one Bitcoin. And maybe there's some ones in like, centralized exchange accounts. So we're probably roughly at 1 million people in the world that have one Bitcoin or more. And there's 57 million millionaires in the world. If eventually even half of them realize they need to have one Bitcoin, where's it going to come from? There's not that many Bitcoins. There's only 21 million Bitcoins ever made. And, 20 million of them, we hit the 20 millionth Bitcoin mined in March of next year. And the last million are going to take over 100 years to mine. So we will be hitting supply shock. Probably not this cycle, but we will always hit supply shock at the top of the bull market. Because usually when people are panic selling in the bear market, good time to stock up. And that's what my book teaches, is basically how to go and sell enough at the high so that you're able to like not be crying when the lows are there, but you're able to actually buy more.
Amazing. Last question. What are your hobbies and how do you kind of spend your free time?
Well, I work all the time. I kind of, I enjoy what I'm doing, and but no, I like to read. I like to travel. I work out. I enjoy working out. That's sort of like just me against man against machine. How much can I lift? And I'm a wine collector, so I like a good bottle of wine, and like I belong to a private club in France that's like a lot of other sort of like high-end wine collectors, and yeah, those are kind of my principal hobbies.
Amazing. Yeah, we launched our first clubhouse in Portugal. Join us. It will be amazing to host you at our clubhouse and try some of the premium wines.
Word, word.
Yeah, and I hope to see you in one of our forums conferences soon. This year we were very frequent. Saw you multiple times, so it was amazing. And thank you
Yes,
for your support.
I've tried to participate in your forums that you've been very prolific at, and I spoke at your LA Tech Week event. I spoke in Cannes, which is a very nice event, and I spoke in Las Vegas last
Dubai,
year, and I think
Dubai, May 1st.
Dubai, of course, yes,
Yeah,
yeah.
yeah,
And so we've collaborated on a number of things between VNTR and Bit Angels, and look forward to more.
yeah. Amazing. Thank you. Thanks a lot for joining today, and looking forward to collaborate with you.
Same here. Thanks, Yuri.
Thank you.